All right, we're down the home stretch. So far we've talked about horizontal analysis, vertical analysis, the profitability ratios, as well as the liquidity ratios. So the last piece of the puzzle and the last piece that you can use in analyzing your financial statement is that related to solvency. So solvency refers to the company's ability to remain in business over the long term. So kind of like that going concern clause that we talked about. Solvency is related to liquidity but differs with respect to the time frame. Liquidity often means the ability to pay the short-term debt, in other words, your short-term bills, where solvency measures the ability to stay financially healthy over the long run. Solvency focuses on capital structure and assesses the extent of borrowing needed. Capital structure refers to the relationship between debt and stockholders' equity. So what we want to look at here is the solvency. Oops, it moves. Solvency refers to the company's ability to remain in business over the long haul. And then when we talk about our capital structure is, how much of this is debt and how much of this is equity. Okay, so obviously we've come up with that. And the first one is what we call the debt to equity ratio. Fairly simple formula. You take the total liabilities divided by the total stockholders' equity. And in this case, this ratio tells us that for every dollar of capital, that's here, equity, of capital, capital stock, and retained earnings, creditors provided 25 cents in the prior year and 24 cents in the current year. Low debt to equity ratios indicate a preference to raise funds through equity, which means selling stock, and a tendency to avoid the higher risk of going out and getting a bank loan. So debt. So what this means is low debt to equity, which is what this is a preference to raise funds to sell stock opposed to going out and creating debt or getting a loan. Our ability to make our payments. And we call this the times interest earned ratio. And I don't really see this used a lot, but I'm sure bankers do. And what this tells you is the ability to meet your current interest payments to creditors by specifically measuring its ability to meet current interest payments out of current earnings. So not in the future, but now. Both interest expense and income tax expense are added back to net income because the interest is deducted from net income to arrive at taxable income. This adjustment gives us a purer measure of income available to pay interest. So we don't want the interest to be out of the net income because you'd be double dipping. This ratio is especially important to bankers and other lenders. So I'm certainly going to mention it to you, but it's not something typically you would use. And the formula, again, is you take your net income, you're going to add back the interest you deducted and your tax, and then divide it by your interest expense. And in this case, it says it's 36 to 1. So that's a pretty good ability to pay back your particular debt. Another one that's often used is what we call the debt service coverage ratio, where it takes our cash flow from operations before interest and taxes and then divides it by our interest and principals. This ratio is purely a measure of our ability to pay back our creditors. First, the ratio considers only interest expense. Management and other decision makers must be concerned about the amount of principal that also has to be repaid. Second, the ratio doesn't take into consideration of the non-adjustments to net income. And these are the two weaknesses of the ratio that I showed you before. So we're again fine-tuning these ratios. So the debt service coverage ratio is used to know whether the amount of cash generated from operating activities can pay back our interest and principal. So in this particular case for Robbins, it generated $1.61 in cash for every $1 of interest and principal paid in the prior year, and $3.28 for every dollar of interest paid in the current year. So we have more than enough to cover our debt here as well. And last but not least, operations to capital expenditures ratio. And effectively, this one is the company's ability to use cash flow from operations to finance property, plant, and equipment. Cash paid for acquisitions is found in the investing activities section of the statement of cash flows. During the current year, this amount is $105,000 and $20,000 the prior year. These ratios tell us that in the prior year, Robbins generated cash from operations approximately 2.4 times greater than what was needed to acquire those assets or any assets. In the current year, it shows that Robbins generated cash from operations to cover only 86% of the needs. So that means that they had to go out and get some money to help cover that. And so this is really good when you're trying to figure out, how we're going to finance something and how we're going to buy something. And so you take the cash flow from operations minus dividends and then the cash paid for the acquisitions. We're probably not going to use this very much. I just wanted you to know that it exists. You could be answered some questions. There are two ratios that I left out in the profitability that I will be demonstrating in class because they're kind of hard to follow along on the video. And one of those is a very important one, and it's what we call ROA, which is return on investment. And the second one would be return on sales. And we'll be covering those Wednesday before we get started. Have a great weekend. Look forward to seeing you back on Wednesday, and make sure you're prepared.